And for an analyst's take on the banks, we're joined now by Nigel D'Souza. He's a financial services analyst at Veritas Investment Research. Nice to see you. Paul's going through a whole bunch of different things to be watching for this earnings season. Is there one issue in particular that you're really going to dig into?
I think cost of funding is going to be top of mind this quarter. We're seeing some interesting deposit trends play out both in Canada and the U.S. In Canada, it's what I call more of a deposit fight. It's a fight to contain and lower deposit costs because we are seeing a shift from demand and notice deposits or checking and saving accounts into term deposits or GICs. That shift towards GICs and term deposits is going to raise funding costs in Canada. In the US, we're seeing what's called a deposit flight, which is deposits either leaving to join systemically important banks or leaving for higher yielding alternatives like money market funds. Both those dynamics, for different reasons, are going to result in higher funding costs for Canadian banks, on both sides of the border. That could pressure net interest margins, reduce margin expansion, and potentially even lead to margin contraction, depending on the magnitude of these trends.
Well, it's, we've talked about it more with the U.S. Maybe we'll talk about this week with Canada. But with the push of a button, you can move money pretty quickly these days. So watching deposit trends is probably important, regardless of the factors behind it. On net interest margins, there's sort of a general belief that when interest rates rise, that is going to open the door for more profitability from the banks. But in your research, you know that some of these banks, in some ways, hedge against that. So it's not always sort of a sort of a black and white equation for the Canadian banks.
That's right. You first have the balance sheet, the asset liability side, the loans and investment securities portfolios. On the liability side, you have the funding aspects. But on top of that, there's a layer of interest rate management and balance sheet management that the banks deploy. Some banks, like Scotiabank, have engaged in interest rate hedging to such a magnitude that their net interest income or margins actually contract when interest rates go up. Others prefer to emphasize margin stability over sensitivity to rates. So if rates go higher or lower, their margins will remain more stable. So they benefit less from a rising rate environment. Those would be banks like CIBC and potentially National Bank. So there's a lot that goes into, a lot of moving parts that go into the net interest margin. And the best way to think about it is BMO, TD Bank, RBC are more interest rate sensitive on the margin side. And Scotia has an inverse relationship, while CIBC and National are less rate sensitive.
For our audience, and it's no secret, you take a cautious view on a lot of the banks. Currently, you have a sell rating on CIBC and BMO, a reduced rating on Scotia and TD. You do have a buy rating on both National Bank and RBC. But one of the other things we were talking about, well, you alluded to the U.S., what's been happening there. Your call on BMO, for example, I assume that is in part just based on the exposure they've got in the U.S. market?
Yeah, when you think about the U.S. banking industry, it typically experiences a higher ceiling of credit losses in a recessionary environment, and it has more tail risks or financial instability than the Canadian banking sector. So BMO is both over-indexed to U.S. banking, and within U.S. banking, it's over-indexed to commercial lending, or both C&I and commercial real estate. And those are the categories that tend to experience higher credit losses during a recessionary environment. And on top of that, the Bank of the West acquisition is adding a bank that's concentrated in California. That's where the epicenter is currently of the regional banking turmoil in the U.S. So there could be some more pressures for BMO. Really
quickly before we go, this is the short term, very helpful. We'll see what happens this week. Longer term, do you think Canadians can still lean on bank stocks and their dividends for their investment portfolio?
Longer term, I think banks that focus on Canadian banking, like RBC and National Bank, are going to outperform banks that chase international banking growth, like BMO, Scotia, TD, and even CIBC now with its entry into U.S. commercial banking. That's a long-term standpoint. In terms of where we are in the cycle, I think we're closer to the floor for Canadian bank stocks than the ceiling, but the floor is probably 12 to 18 months in terms of the horizon. Okay.